Hello students, welcome to the lecture on accounting of non-trading institutions, and after the lecture we will be able to learn the following objectives. Understand the concepts on accounts of non-trading institutions, discuss the receipt and payment account, understand the income and expenditure account, discuss the difference between receipts and payments and income and expenditures account. Let us start with a brief introduction. Organizations are established for the purpose of rendering social services to its members and to the society are known as non-trading concern. Such organizations include clubs, schools, colleges, hospitals, libraries, trusts, professional associations, and unions. These organizations render their service to the members and to the general public, such as a club provides sports and other recreational services to the members, schools and colleges provide education services, hospital provides treatment and services to the patients. The sole object of non-trading concern is to provide necessary services to its members and the society at large through welfare activities. The aim of such organization is not to make profit. They should prepare systematic books of account to provide necessary information about receipts and payments. It also helps to know whether the current income is sufficient to meet the current expenditures or needs. The balance sheet is prepared to know the financial position, besides providing information about the proper utilization of grants, donations, and so on. Proper accounting is essential for non-trading concern to provide the required information. Such institutions bear receipts and payment accounts to show the receipts and payments of cash. Income and expenditure account is prepared to know the surplus or deficit for the period. Balance sheet is prepared to know the financial status of the concern. The detailed and transparent financial information of non-trading concern can be obtained by preparing receipts and payment account, income and expenditure account, as well as balance sheet. Let's talk about the concepts of non-trading institutions. Individuals or institutions with activities other than trade are known as non-trading concerns. Examples of non-trading concerns are clubs, hospitals, libraries, college, athletic clubs, etc. These institutions are started not for carrying on a business and making a profit, but for some charitable, religious or similar purpose. Their income, which is derived from donations, subscriptions, entrance fees, etc., is spent on the objects for which they are started. Non-trading concerns usually maintain their accounts by the double entry system and periodically prepare their final accounts for the submission to their members and subscribers. The method of preparing final accounts by non-trading concerns is different than trading concerns. The method of preparing final accounts by non-trading concerns is different than trading concerns, as these concerns does not deal in any goods like trading concerns, so they cannot prepare a trading and profit and loss account. At the end of the year, they make out an account called an income and expenditure account and balance sheet. The income and expenditure account serve the same purpose as the profit and loss account in the case of trading concerns and is made out exactly in the same manner. Usually the non-profit making institutions do not maintain a full set of books but merely a cash book in which all receipts and payments are entered. At the end of the year, the cash book is summarized under suitable heads and the summary thus prepared is called a receipt and payment account. In order to know the result of the year's working, it should be converted into income and expenditure account.
There are a few things that I think nonprofits need to know, and too often they don't. As I've worked with not-for-profit organizations over the years, I realize that they don't know they really are a business. Again, you bring people in with passion, they often don't know. They need to run that not-for-profit like a business. That is very important. Another important thing that nonprofits need to do is have financial policies. Most of the time, folks are following some sort of unwritten procedure, just doing things day to day. Somebody's out, somebody else goes ahead and runs a check or whatever. But there are no controls, no internal controls. There's nothing written so that nobody knows what's really going on in the financial and accounting area. So it's really important that you have financial policies and you can bring folks into the organization if someone leaves and they can look at, these are the policies, now I know what to do. The other very important thing is to know what is your cash balance. Most folks know if they don't have enough money to make payroll, and certainly that causes a lot of sleepless nights, I know, for executive directors. But it's really important to plan and to say, okay, what are my cash needs 30 days out, 60 days out, 6 months out? Because if you know your cash needs, then you can go about making sure you're meeting those needs. You can talk to the board of directors. Perhaps you need to do some more fundraising. Perhaps it's time to cut some of the costs. But if you don't really project out, then you find yourself always being burdened by, oh my word, I can't make payroll tomorrow, what am I going to do? So it's important to do that planning. And another thing that nonprofits need to be doing is trend analysis. It's always so much fun to go in and look back maybe 5-10 years at how something is doing. Let's say it's a fundraiser. So we run the numbers on the fundraiser, we actually put it into a chart, take a look at that, and it's really interesting to see the way that looking at trends in an organization changes the way a board of directors looks at what is happening in that organization. Another thing that we need to be doing is budgets. Budgets are very, very important. Those budgets should be kept in your financial software. We see a lot of folks either not having budgets or managing their budgets outside of the financial software. So they dump the income statement or rekey the income statement into, let's say, Excel, and then look at a budget there. There's too much room for error. Those things need to be inside your financial package. You need to be budgeting not only by your total company, but also by your programs. The other thing that is important, and too many not-for-profits have really not taken advantage of, and that is the fact that you need to make a net income at the end of the year. Not-for-profit doesn't mean losing money, and it doesn't mean making zero. We have to be sure we are planning for the future. During this rainy day season that we've had lately, in terms of the economic climate, we've seen way too many nonprofits go by the wayside. You have to plan for that rainy day. Some say your reserve set aside should be as much as 1 year of operations. You and your board have to decide how much is a good reserve amount for you, but start building those reserves. If you want your nonprofit to continue into the future and you provide a good mission, you should be making money at the end of the year and setting aside for your reserve.
Now we shall talk about receipt and payment account. Receipt and payment account is a summary of cash receipts and payments during the accounting period. It records all cash receipts and cash payments, including capital receipts and revenue receipts, irrespective of accounting period. All cash receipts are recorded on debit side or receipt side, and all cash payments are recorded on credit or payment side of receipts and payment account. Receipt and payment account is a mere summary of cash book for a year. It begins with the cash in hand at the commencement and ends with that at the close of the year. Similarly to cash account, in receipts and payments account, receipts are shown on the debit side while payments are shown on the credit side, without any distinction between capital and revenue. Moreover, it does not include an unpaid expenditure, not only unrealized income relating to the period under review, and so fails to reveal the financial position on the concern.
Cash book and types of cash book. Let's understand what is the meaning of a cash book. Now, just like the name itself suggests, a cash book is a book which records cash transactions. Okay? So whatever receipts are there in respect of cash, and we know that what is the journal entry for receipts? Because when cash comes in, the asset increases, so we debit cash account to XYZ, whosoever is the party. Okay? Or any kind of a payment. Let's say you make a payment to XYZ, debit to cash. These payments can also be in respect of expenses, assets, and whatnot. So all these entries relating to the receipts and payment of cash are recorded in the cash book. Right? But a cash book is not that simple, in the sense there can be 3 types of cash book which are there. One is called a simple cash book. Right? The simple cash book simply takes into account cash transactions. right? The second type of cash book which is there is a 2-column cash book. It's not difficult to guess what the other column will be. I gave you a hint in the previous video. One is obviously the cash. The second column takes into account the bank transactions, right? So what will happen is that it will have 2 columns instead of 1, and one column will be for cash, the other one will be for bank. And the last one is a 3-column cash book. Okay? 3-column cash book. This has 3 columns, one for cash, one for bank, and one is for discount. Right? So in respect of any of the transaction, right, whatever is the discount given. Now discount is what? Discount is an expense, right? If it is given, so it is recorded on the debit side. Whereas any discount received is an income and it is recorded on the
features of receipts and payment accounts. The essential features of receipt and payment accounts are summary of cash transactions. All cash receipts and payments made by the concern during the accounting period are recorded in this book. Therefore, receipts and payments account can be taken as a summary of cash transactions. Cash and bank items in one column. All receipts, either cash or bank, are recorded in receipts columns of receipt sides, where all cash and bank payments are recorded in one column of payment column of receipt and payments account. The cash and bank transactions are merged to avoid contra entries of cash and bank transactions. No distinction between capital and revenue. All cash receipts and cash payments, irrespective of capital and revenue nature, are recorded in receipts and payments account. No distinct is made for capital receipts, capital expenditures, and revenue expenditures. Opening and closing. Balance of cash receipts and payments account starts from opening balance of cash and bank ends with the closing balance of cash and bank. Recording of cash receipts and payments. All cash and check receipts are recorded on debit side, where all cash and check payments are recorded on credit side of receipts and payments account. Ignores non-cash transactions. Receipts and payments account does not record non-cash transactions. Limitations of receipts and payments accounts. The receipts and payments account suffer from the following limitations. Receipts and payments account does not differentiate capital and revenue expenses and incomes. Receipt and payments account fails to show expenses and incomes on accrual basis. Receipts and payments account fails to show surplus and deficiency. Receipts and payments account fails to show non-cash transactions such as depreciation of fixed assets, pilferage, etc. Advantages of receipts and payments account. The following are the advantages of receipt and payment account. Total receipts and total payments under various heads are available at a glance. The amount of cash in hand at the year end can be ascertained. The correctness of cash book can be verified through it. The total of debit side of cash book will agree with the total of the receipt side of this account. On the other hand, the total of credit side of cash book will agree with that of payment of this account. Let's study in brief the income and expenditure account. Income and expenditure account is merely another name for profit and loss account. Such type of profit and loss account is generally adopted by non-trading concerns like clubs, societies, hospitals, and like, etc. This account is credited with all earnings, both realized and unrealized, and debited with all expenses, both paid and unpaid. The difference represents a surplus of deficiency for a given period, which is carried to the capital account. It should be noted that items of receipts or payments of capital nature, such as legacies, purchases, or sales of any fixed asset, must not be included in this account. How to convert a receipt and payment account into income and expenditure account. The following steps will be necessary to convert a receipt and payment account into an income and expenditure account. Opening and closing balances of receipt and payment account should be excluded. All items of capital receipts and payments should be excluded. All incomes of previous years or for years to come should be excluded. All expenditures of previous years and years to come should be excluded. All accrued income and outstanding expenditures relating to the period should be included. Items such as bad debts, depreciation, etc. will have to be provided. Treatment of peculiar items. Generally in exercises, the instructions are given as to the treatment of special items. Such instructions are based on the rules of the concern. These should be followed while solving questions. In cases where no specific instructions are given, the following guidelines may be considered. Legacy. It is the amount received by the concern as per the will of the donor. It appears in the receipt side of receipt and payment account. It should not be considered as an income but should be treated as capital receipt, that is, credited to the capital fund account. Donation. That is, the amount received from any source by way of gift is described as donation. It appears on the receipt side of the receipt and payment account. Donations are usually credited to income. Rules of the association may provide that a part of donations are to be treated as capital. However, if donations are received for a specific purpose, viz. Building, free dispensary, etc., then it should require special treatment. Subscription. The members of the associations as per rules are generally required to make annual subscription to enable it to serve the purpose for which it was created. It appears on the receipt side of the receipt and payment account and is usually credited to income. Care must be exercised to take credit for only those subscriptions which are relevant. Life membership fees. Generally, the members are required to make the payment in a lump sum only once, which enables them the members for whole of life. Life members are not required to pay the annual membership fees. As life membership fees is substitute for annual membership fees, therefore it is desirable that life membership fees should be credited to separate fund and fair portion be credited to income in subsequent years. Entrance fees. Entrance fees are also an item to be found on the receipt side of receipts and payments account. There are arguments that it should be treated as capital receipt because entrance fees is to be paid by every member only once, that is, when enrolled as member, hence it is non-recurring in nature. But another argument is that since members to be enrolled every year and receipt of entrance fees is a regular item, therefore it should be credited to income. Sale of newspapers, periodicals, etc. As the old newspapers, magazines and periodicals, etc. are to be disposed of every year, the receipts on account of such sales should be treated as income and therefore to be credited to income and expenditure account. Sales of sports material. Sale of support materials used is also a regular feature of the clubs. Sales proceeds should be treated as income and therefore to be credited to income and expenditure account. Honorarium. Persons may be invited to deliver lectures or artists may be invited to give their performance by a club for its members. Any money so paid is termed as honorarium and not salary. Such honorarium represents expenditure and will be debited to income and expenditure account. Special fund. Legacies and donations may be received for specified purchases. As discussed above, these should be credited to special fund and all expenses related to such fund are shown by way of deduction from the respective fund and not as expenditure in income and expenditure account. Capital fund. Any concern whether profit-seeking or non-profit-seeking requires money for conducting day-to-day functions. In the case of profit-seeking concerns, such money is called capital, while in the case of non-profit-seeking concerns, it is called capital fund. The excess of total assets over to external liabilities of a concern is called capital fund. Capital fund is created with surplus revenue and capital receipts and incomes. It is shown on liabilities side of balance sheet. Features of income and expenditure account. The main features of income and expenditure account are: income and expenditure account is a nominal account. Therefore, the rule of nominal account, debit all expenses and losses and credit all incomes and gains, is followed while preparing it. The opening and closing balances of cash in hand and cash at bank are not recorded in it. It has no opening balance. While preparing it, only items of revenue nature are recorded and all items of capital nature are ignored. Incomes and expenses pertaining to only current year are recorded in it. All items of income and expenditure which pertain to previous years and future years are not recorded in it. Income and expenditure account is prepared in the same manner in which profit and loss account is prepared. Therefore, all adjustments for the current year regarding outstanding expenses prepaid. Therefore, all adjustments for the current year regarding outstanding expenses, prepaid expenses, income in arrears, income received in advance, depreciation, etc. are made while preparing it. The closing balance of this account shows surplus or deficit for the year. If the credit side exceeds the debit side, there is surplus. On the other hand, if the debit side exceeds the credit side, there is deficit. The surplus is added to the capital fund while the deficit is deducted from the capital fund. Income and expenditure account is prepared at the end of an accounting period. Income and expenditure account contains revenue items only. Income and expenditure account is prepared on an accurate basis.
And revenue income. Capital expenditure. If we have capital income, then it's used to buy assets for the business. Therefore, capital expenditure must be the purchase of those assets. So capital expenditure for fixed assets refers to expenditure on buildings and land, plant and equipment, office equipment, and motor vehicles. And those are all called tangible assets. We can see them, we can touch them. Right? Buildings and land, plant and equipment, office equipment, and motor vehicles. Those are our tangible assets. We can also have capital expenditure for intangible assets. These include trademarks, patents, and goodwill. So, why does a business want to try and buy these? Well, let's just consider the patent on a drug. If you hold the patent for a drug, then you can license other companies to make the drug and get a lot of money back from it, so it then will raise something worth buying. In other words, it's going to yield income. Revenue expenditure. This is the expense of running the business on a day-to-day basis, and it includes use of electricity and gas for heating and lighting, the use of petrol, gas or diesel to run vehicles, paying staff wages or salaries, even such items obviously as using the telephone. All of those are types of revenue expenditure. Now, how do we decide whether it is capital expenditure or revenue expenditure? Let's consider Liz, who runs an estate agency and records the fixed assets of her business in a register. During the last month, she's purchased a new car to visit properties, and she paid £16,500 for this car. It's a bit much for that Fiat. She also bought an office desk for £700. She might need a new employee for the desk, however. She bought a printer for £45, a stapler for £13, and a pencil sharpener for £2. So, how does she decide what to record as an asset? Right? She's bought a car, a desk, a printer, a stapler, and a pencil sharpener. There are two questions which are important here. First of all, will the item be used by the business over a long period of time? And is the cost high enough to record? Now, Liz decides that the pencil sharpener really isn't likely to last that much time, so she's not going to bother with that. And what about her printer? Well, what she decides in the end is that unless it costs over £100, she isn't going to record it as an asset. If the cost is less than £100, then she's going to treat the item as an expense. Now, each business will decide where to draw the line for this purpose.
Let us now understand the difference between receipts and payments and income and expenditures account. The main difference between receipt and payments account and income and expenditure account are nature. Receipts and payment accounts is a summary of cash transactions for a period, and it is a real account. Income and expenditure account is a summary of expenditure and income, like trading and profit and loss account. It is a nominal account. Objective. Receipts and payments account is prepared to show cash and bank receipts and payments during the period to derive closing balance of cash and bank. Income and expenditure account is prepared to show the net result of the operation during the period to derive surplus or deficit. Recording. All cash and check receipts are recorded on debit side of receipts and payments account, whereas all cash and bank payments are recorded on the credit side. In income and expenditure account, all expenditure of revenue nature are recorded on debit side, and all incomes of revenue nature are recorded on the credit side. Capital and revenue items. There is no distinction between capital and revenue receipts and payments in receipts and payments account. All expenses and income of revenue nature are recorded on accrual basis in income and expenditure account. Contents. Receipts and payments account contain only cash and bank transactions. Income and expenditure account contains both cash and non-cash expenses and incomes of revenue nature. Balance sheet requirement. Receipts and payments account is not required to prepare balance sheet. Income and expenditure account is required to prepare balance sheet. Adjustments. No adjustments are required in receipts and payments account. In income and expenditure account, adjustments are made because it is prepared on accrual basis. Now in the end, let us summarize what we have learned in this lecture. The sole object of non-trading concern is to provide necessary services to its members and the society at large through welfare activities. Individuals or institutions with activities other than trade are known as non-trading concerns. Non-trading concerns usually maintain their accounts by the double entry system and periodically prepare their final accounts for the submission to their members and subscribers. Receipt and payments account is a summary of cash receipts and payments during the accounting period. Receipts and payments account starts from opening balance of cash and bank ends with the closing balance of cash and bank. Income and expenditure account is merely another name for profit and loss account. Such type of profit and loss account is generally adopted by non-trading concerns like clubs, societies, hospitals, and etc. Entrance fees are also an item to be found on the receipt side of receipts and payments account.